It's a pleasure to be here and an honor. And I'll be talking about, I'll make sure we get this. There you go. Capitalizing entrepreneurship, the rise of growth equity. As Mara foreshadowed, my day job, I'm the professor of finance at the University of Oklahoma, but I'm also, visiting professor at UIBE in Beijing, finance area editor at the Journal of International Business Studies, and as of, for the last several months, short-term consultant for the World Bank. So it's, as you'll find, those of you who are starting out, as you become senior professor, which I kind of term is wretched term, but it's true, things, you accumulate things. You accumulate part-time jobs, and this is one of the, I'm enjoying all of them. This is the, we don't seem to have a one by one, so they're coming up individually or together. It's co-authored. It's co-authored paper, but it's not a paper yet. So trust me, it's going to be brilliant when we get it done, but it's what I'll have is the presentation, an overview of the paper that we're developing. And it's going to be with this handsome gentleman over here, Gabriel Latanzio, who's at Nazarbayev University, and Lou Bolotov, who's one of my colleagues at the University of Oklahoma. Okay, so what is growth equity? And what role has it played in the, which I'll show you, the truly massive growth in private capital since 2000. It's just, it really is rather extraordinary when you see it. Where do I need to do it this way? There you go. Oh, here you go. What growth equity is private capital, actually private equity capital. Those of us who work in venture capital and private equity, and this resulted from that. I was assigned to teach a course in venture capital and private equity, master's course, in 2020. And by the way, if any of you have to do that, I'll be happy to share my stuff, because you don't really want to go through that investment if you don't have to. It was quite a bit to get it started, but it's absolutely fascinating. This is now one of my core teaching duties, is to teach this class. And in teaching it, one of the things as I was going through it, and all the charts and all the graphs about venture capital and private equity, there was this thing called growth between them. And it was like, what in the world is this? And actually, turned out nobody knew. There was almost nothing written about it. And yet it was $100 billion a year, total assets under management over $1 trillion. So this is a really pretty important thing. So what is it and why do we care? Okay, so growth equity is private equity fund. Growth equity fund is a private equity fund that's organized as a limited partnership, just like venture capital and buyouts. I mean, these are, if you're working in private equity, you know these are strange looking beasts. It's a very important form of capital for business, and yet it's not a corporation. Private equity funds are organized as limited partnerships. Partnerships are completely gone in all the rest of finance, except in the private equity hedge fund, this area. And they're organized as limited partnerships, limited life, with a 220 compensation scheme, 2% for the general partner as annual compensation of the committed capital, and 20% of the profits that come out. So there's very special form of private equity. These firms invest directly in rapidly growing private companies, and that one of the things that I'll talk about later, but we all probably know, is the number of listed firms in the U.S. has declined by half since the mid-1990s. Now, they're huge. The total value of stock market has gone up 6 times, but you have half as many firms. So what is happening is companies can delay going public. Sooner or later, they probably will have to, but they delay it until they're multi-billion, or in the case of Uber, $40 billion companies before they finally go public. This is part of what has allowed that to happen. If you can stay private longer, you would want to, right? If you could delay having to face public shareholders, go through all the cost and hassle of an IPO, and still get the capital you need, this is going to be very important. Experience spectacular growth, as I'll show in a minute. And they have investment returns. All of private equity is like this, have investment returns that are much, and pretty well documented now, much superior to public markets, which have done pretty well the last 10, 15 years. But it's much better in private equity. And within private equity, growth equity and venture capital have done the best, have very good returns. Okay, this was the first, much of what I did when I started out this with our co-authors is look and just, when did this start showing up in the literature? both the practitioner literature and the academic literature. It turns out this was the first really good description of what growth equity was by Andrea Auerbach, Cambridge Associates. She identified the type of company and the funds that they invest in. And let me say this. If you have questions, I think the way we probably want to work this, if it's okay with you, is if you have explanatory questions, something's not clear, please go ahead and ask now. But then there'll be time at the end. I've done this at OU, so I know we'll finish in plenty of time to have questions at the end. Okay? So this is what the features that Ms. Auerbach presented as characterizing growth equity. So they're founder-owned or managed, or their heirs, so family businesses with no prior institutional equity investment, so they haven't had venture capital, proven business model, preferably in tech, rapid growth, sustained substantial revenue growth, and they're either profitable, EBITDA positive, or soon to be, with little or no leverage. Now, when you look at these are kind of strange looking companies in themselves. This is not your typical business that you see, but the growth equity almost always takes a minority stake, right? If they're buyout firms, almost by definition, you're buying 100% or at least 50% of the company. You take minority stakes and you structure the investment as preferred stock, usually convertible preferred stock, which we know this is how venture capitalists do it, how they make their investments all the time. And they presume no further external equity investments until exit. Now, this is the growth of private capital. This is not publicly traded assets. This is the growth of private capital since 2000. And you can see it's gone from 500 billion in 2000, and this is the end of 2020, to 7.2 trillion. So a 15-fold increase in private capital in 20 years. Phenomenal increase in the value of private capital raised. Within that, this growth equity is the fastest growing of all, 21% compound annual return. Now, we're finance folks. We know about the rule of 72, right? How long does it take money to double? It's anything that the product is 72. So at 8% interest, it'll take 9 years. At 6% interest, it'll take 12. It's a handy rule of thumb. 21%, you're going to double your money in 3.5 years. So a phenomenal growth rate for the growth equity within this rapidly growing universe of private capital. There you go. This is the growth of private asset values versus market capitalization of public stocks. And you can see that the public stocks have done pretty well. They've tripled in value since 2000. Actually, I'll show in the next slide, they've done a bit better than that. But private equity net asset value has gone up 14 times. So it's had 4 times as fast as public market capitalization. Most of that has come about since 2016, or the fastest growth has been in the last 6 years. Okay? I've been keeping this chart almost since I was a doctoral student. So this is the total value of stocks in the world, listed stocks, the total market capitalization of the world since 1983. 1983, $3.3 trillion, which was a record at the time, 2/3 of it U.S. Now, or at peak in late 2021, 121 trillion. So 40-fold increase, as I've said many times. When I started the PhD program in August 1982, the Dow Jones Industrial Average was 775, and it peaked earlier this year, late 2021, at 36,000. So in the course of a not yet complete career, it's gone up 45 times. This has been a really good time to be a finance professor. This has been a really fun time to go around the world and say, why is this going so well? Okay, and you've had phenomenal growth over the time. So, punchline of this, and I'm going to show a couple of slides here that may seem off topic, but trust me, they have a reason. Publicly listed stocks are still far more valuable than private capital. The total amount that's of public equity is much, much larger than private equity, but the flow of private equity has become vastly larger than the flow of public equity. All right, this is another chart that I figured out a way to to give in every presentation I ever give on church groups, Boy Scout groups. I always find a way to bring this in. This is corporate security offerings, public offerings of securities by corporations, not governments. So you can see from 1990 to 2021, 1990, a record $500 billion were issued by corporations, 2/3 of it U.S. By last year, 2021, it was almost $11.5 trillion. Now we're running at about a $10 trillion pace this year, so it's still very, very elevated. So you can see this, the mix of U.S. versus foreign. So fundamental point number one, when I teach international or corporate finance, I try to drive this home. Fundamental point number one, for large corporate companies around the world, corporate finance means capital market finance, right? So that's the first point. If you had a similar chart for bank intermediation, bank assets provided to companies, it would go up, but it would be nothing like this. So point one, for global large companies, corporate finance is capital market finance. Fundamental point two, capital market finance is debt finance. So you have, this is worldwide, you can see 11.4 trillion, of which 10.2 trillion was debt. So the vast majority of the securities that corporations issue are bonds. If we thought it through, we'd probably come to see why that's the case. The total equity, 1.2 trillion, complete record, but that's gross. By the time you take out share repurchases, $1 trillion in the U.S., by the time you take out cash acquisitions, $4 trillion, the net equity issuance around the world is negative several $100 billion every year. As a source of capital, public market, a source of equity capital, public markets are round off error, except for, there you go, except for IPOs. IPOs are important, but again, it's $4 billion, $413 billion last year, a record. And yet that's a very small fraction of the total value of equity. So only $400 billion was raised in IPOs. 120 of that was U.S. And that's gross, not net. Net equity issuance are negative almost every year. And the U.S. hasn't been the number one IPO market for a decade and a half. It's been China, and it always is. Now, many times larger than the U.S. So the point of all this, corporations have been able to raise capital. Most of what they raise publicly is in the form of debt. The equity issues, the most important source of equity capital, of course, is always going to be retained earnings. After that, it's private equity. Not even close. So this is the distribution of private capital at first half of 2021, the most recent available. So the total is about 10 trillion. And this is a year and a half ago, so it's probably 12 trillion now. Private equity is 6.3 trillion. Of that, growth equity at this time was 988 billion. It's about 1.2 trillion now. And you can see, and I'll come back to this, over half of the growth equity is in Asia. All the rest of private equity, overwhelmingly in the U.S., North America, but mostly the U.S. But most of the growth equity is in Asia. Okay, so this is from our, we've just now started collecting data. This shows the growth in the number of venture capital, the gray bars, growth equity, and buyout funds has risen very, very sharply. All right, so what I'll turn to now is this growth equity a distinct new form of private capital? And if so, it would be hugely important. I've been doing this for 40 years. I haven't seen a new form of equity capital come around. If this was really a new form of corporate finance, providing corporate finance, it would be very, very important, both for the economy and for us as researchers. This would really be nice, pretty nice. And you can see kind of where it lands in the spectrum. Friends, family, and fool money is the first source of capital for business. Then business angels, venture capital, this natural progression up to an IPO. Okay. Now, this has been one of the things that I spent quite a bit of time going through, finding out, the practitioners and academics who talk about this, relative few that do, struggled with whether it's a separate class. Is growth equity in and of itself a third form of private equity, or is it late stage venture capital or early stage buyout? Well, quite a few folks, two people, at least two academics, refer to it as late stage venture capital. A lot more classify it as buyout funding, a form of buyout financing. All the way down here, so the majority of folks who have commented on it see it as buyout, a form of buyout funding, which kind of struck me as odd. Looking at it, it has much more characteristics of late stage venture capital, but this is what the literature has found. Now, it's pretty well, now quite a few folks, both in the academic and practitioner literature, are classifying it as a separate class of itself, a new form of private equity. Bill Ford, who's an entrepreneur, financier, founded this General Atlantic Fund, 1980, was the first growth equity fund and still the largest, although all the other buyout funds and others are getting into the act. Blackstone had a $4.5 billion growth equity fund last year. These are scale of fund issues that had used to be just unheard of. So you have a lot of them now. The most of the folks who talk about it classify it as a separate form of buyout, and that's true as we go down. I won't go through each one, but they struggle because it really has characteristics of both venture capital and buyout, and whether or not it's separate is an important question. So the consensus now seems to be that it is a separate class of private equity, a separate class of corporate finance. All right, is this really the case? And if so, how does it differ from other types of buyout funds? And I'm going to have a bunch of charts here to show this. Well, first is, and I'll expand this when we get to the paper, just to document it really has taken a long time for this to grab hold, either in the academic or the practitioner literature. The first mention that I could find in anywhere was Wall Street Journal in 1998. The first mention of a growth equity fund form was 2001. Economists first mentioned it in 2007. The Financial Times in 2008. The McKinsey Global, there's McKinsey Global Private Equity, PitchBook Private Equity Report, and then the McKinsey Global Equity and Bain are the major commentators on private equity. And it took them to the middle of the decade at the earliest to start mentioning this. The first academic mention was 2001. The first one that actually mentioned it by name was 2016. So this is something that is really, it's been around. People have seen it, but really haven't commented on it. This is the growth equity investing. This is out of the Financial Times. But you can see that it's gone from a round off error, 100 billion maybe, well under that, probably 30, 40 billion to 1.2 trillion since 2000. In 2021, it was $113 billion were invested. 132 billion was raised. This is a big, big source of capital. Again, that's bigger than IPOs. Just that is bigger than, or the same size as U.S. IPOs. Beginning in 2014, the Bain Global Equity Private Equity Review, the first time they mentioned it, first time they broke it out separately. So now you have it. It's this section right here. Before 2013, it didn't show up at all. But you can see it's a major source of a big fraction of the total private capital that's raised, and it's been growing very steadily over time. It looks like they didn't talk about, no data provider does, when they reclassified something, but it looks like before then it was mostly classified as venture capital, to the extent we can determine. Okay, this is dry powder. Those of us who are working in private equity know the term. Dry powder is the capital that has been raised. It's committed, it's actually been collected, but it hasn't been invested. So this is money that's just sitting, waiting for a home, waiting to be invested. For the whole private capital, it's over almost $3.5 trillion just waiting to be invested. And you can see there's a lot of it in every category of private equity, capital that's just waiting to be allocated. Okay. This is the geographic distribution of the different classes. You can see venture capital's fraction of the total global has been going up steadily. Read that. China, India are the two biggest sources of that. And in recent years, India is the third largest target for venture capital. China is the second largest. Britain is usually either third or fourth. U.S. is always the largest. Growth equity, over half of it is in Asia, particularly China. Why? Well, The Economist has the best description we've seen so far. In Asia, it's for cultural, institutional, political reasons. Leveraged buyouts are not welcome. Control is not sold very often, very commonly. And highly leveraged deals are not welcome. So for a variety of reasons, this is largely in Asia. And now this one is quite interesting in that this is from Bain. This shows that the growth, venture capital growth and buyout returns all exceed public markets. Public markets have done really well over 3, 5, 10, 15 years, but private equity has completely dominated, done much better than public equity. Within that, growth has been second only to venture capital. Early stage, late stage venture capital, growth, and buyouts. One thing I don't have on the slide here, but it's worth mentioning, in this Bain report, they mentioned that finance is over 20% of world GDP. I knew we were important, but I've never seen a number that big. But again, that's what they reported, is that finance around the world is more than 1/5 of total world GDP. World GDP is about $100 trillion, so this is a very big industry. Okay, the Wall Street Journal, in their first really detailed discussion of this in 2013, said that growth equity had outperformed venture capital up to that point. Those of us who work in the literature know the literature. The Kaplan et al. Journal of Finance, 2014, I think it was, they said that buyout funds had done better than venture capital. That's been reversed. The last half of the 2010s and now, venture capital is doing much better, doing significantly better than buyout funds. But what's the growth equity agenda for research? We have both immediate goals that we want to do for this paper, and I'll lay out some long-term goals. And anybody who's interested in this, the slides will be available. You certainly can look at it and encourage it. Okay, so what our first study will do, and we're only now getting it, beginning to get it, is to see just how large these are. Do these meet our box standard? In other words, is this really a separate class of private equity? So how large is the average growth equity investment? More than twice as large as late stage venture capital. So they're much bigger than late stage. Now, buyout funds are several hundred million to sometimes even close to $1 billion average size. The 2021 growth equity was 125 million, 56 million for late stage venture capital. How big a stake do they purchase? My colleague Lubo is looking at this now. It is significant, but far, far less than 50%. Somewhere in the teens, probably, is what it looks like it'll come out to, which is what venture capitalists do. Venture capitalists almost never buy anything close to majority, whereas buyout funds, of course, always buy 51% or more, or 100%. This also predicts that growth equity will insist on ratchets. Those of you who are not familiar with it, a ratchet is in a venture capital investment. So you make your first investment at $1 a share. And the presumption is that the firm does well, your next investment as a venture capitalist will be at $5 a share. Then the next one at $10 a share, an up round. Many of them don't work that way. FedEx didn't work that way. FedEx had 2 down rounds, which means that instead of you buy it, the first one is $1, the next one may be at 50 cents, and then the next one at 20 cents. And with a full ratchet, what happens is those who participated in the first round, if it's 50 cents and they bought 100 shares, they get another 100 shares. just to compensate them for the fact that the stock price has gone down. The entrepreneur does not, but the venture capitalists do. So this protects the venture capitalist, protects the investor. And if you look at it, Fred Smith ended up owning about 1% of FedEx because of these 2 down rounds. Okay, so they protect themselves with investor protection brackets, other veto rights, other redemption rights, which is very much like venture capital, but unlike buyouts. Is this their first large external investment? We just got data today. This does not seem to hold. It looks like the growth equity is very frequently a late stage investment. So we'll see whether this holds up over time. That's a core prediction. So if we find it, this is work in progress. Do they really focus on profitable firms, particularly in tech? Yes. We also found that today. They look at profitable firms with established businesses that are growing very rapidly. This is clearly what they invest in. Do they like low leverage? Everything we've seen, we don't have data on this yet, it probably is the case. These are equity investments in low leverage or no leverage firms, mostly tech. And then finally, if they use preferred stock? Now, those of us who've looked at venture capital know that almost without exception, American venture capitalists invest in convertible preferred stock. They don't buy common stock of the target company. It's convertible preferred stock. Preferred stock has gone away everywhere else in finance, except in venture capital, and now here. So we expect to find that, and I'm virtually sure we will. Okay, to extend this, the last several slides I have are research extensions, right? And if you're interested, this is something that you might be participate in. These are recent venture capital buyout studies that show important results. And we hope to be able to test their implications in growth equity. Fang, Evershed, and Lerner look at co-investments by limited partners. In other words, you're not just investing in the equity fund, the venture capital fund, but they're allowing you to make direct investments with them, co-investments. They found that these underperform the funds themselves. So the venture capitalists don't let them in on the very best deals, on the very best terms. So we'll test whether that happens, or someone can test whether that happens in growth equity. This is a really interesting study, the second one here. This is in Journal of Finance. And they ask where does the value in venture capital come from? Is it the Kleiner Perkins, Sequoia Capital, Horowitz, the fund, or is it the individual venture capitalist? Where's the value that comes about? Overwhelmingly, it's the person, not the institution, not the organization. So we'll see whether that also holds up for growth equity. We predict a similar directional, it'll have the same basic impact, but it won't be as important as it is in venture capital, because venture capitalists are involved very early and throughout the early development of the firm. In a way, growth equity are going to be much more passengers. They come on when the firm's already established. They provide capital. They're partners, but they are not really supervisors. The growth Deutsch, Crowley, and Stoltz, this is the listing gap study, very important study. What they showed was that this is the listed firms in the U.S. and non-U.S. listed firms. What's wrong with this picture? 1996, the number of listed firms in the U.S. peaked. Now, they went through 2012, so the U.S. economy was, 2.5, 3 times larger over that, 2 times, let's just say 2 times larger over that period, and yet the number of firms had declined in half. Whereas for the rest of the world, it's gone up. Even other developed countries, it had gone up. What's wrong with this picture? And basically Gabrielle and I have a paper on this as well, look at explaining this, some of that we don't have updates here, but what we find is this is now universal. It's still down around 4,000 companies in the U.S., and the same thing is happening in the big countries of Europe, Germany, France, Britain, So all over the world, the number of, in the developed world, the number of listed firms is stable or declining. So something fundamental is happening in capital markets and corporate finance. The more capital than ever is being channeled to companies around the world. But it's not going through markets. It's not going through listed firms. In many ways, what we've kind of thought about this and concluded is that growth equity, it's counterfactual, is an IPO. This is a substitute for an initial public offering. Normally, firms at this stage, historically, would have their IPO, and that's where they would get the capital. Now they have a private source of capital, so you can delay that IPO either indefinitely or for many, many years. Okay. This is sort of tangentially related, but it's a buyout study. Looks at credit conditions, what determines fluctuations in the level of leveraged buyouts in the economy. Is it credit conditions, tightness of the credit markets, or is it fluctuations in the equity risk premium? They find that it's fluctuations in the equity risk premium, not credit markets so much. It'll be interesting to see if we'll find it here. We certainly don't expect it to be either significant or certainly not as significant because it's pure equity financing. So you wouldn't expect it to be that dependent on credit conditions. The second paper here, Journal of Finance, doesn't mention growth equity at all, but what they look at is how do early stage investors in venture capital firms make the determination of who to invest in, what firms to invest in? Is it the other lead investors, if you have a top tier venture capital firm, or is it the management team itself? It's the management team itself. So the logical corollary to that is for growth equity, they're going to be looking for performance. And in contrast to venture capital, these firms actually have a history. You can look at real performance, not possibilities, is what you look at in venture capital. A long-running debate in leveraged buyouts is, are these locusts or do they create real value? In many ways, it's still unresolved. The recent study, 2019 JFE, looking at German buyouts, showed that basically they're locusts, right? They don't create any value. The employees are hurt. Their wages go down. Their employment is reduced. Whereas a more recent study in the Journal of Finance, 2022, find just the opposite. That this creates value. They enhance their sales without increasing the price. That this creates real value both for the company and for the economy. So a clear test of this for growth equity is very straightforward. Is this the case? Are they locusts? Are they creating capital and creating value? This is the skilled investors outperform. So private equity investors, is it their skill or is it luck or something else? And unsurprisingly, but fairly definitively, they show that it's skill. The investor skill is really important, increases the return by 1 to 2 percentage points over time. So, human capital matters. I have one more slide after this. Shareholder protection strongly predicts new market success. Shea Bernstein, Josh Lerner, of course, show up time after time in this literature. And what they look at is what determines stock market success. All over the world, I've been doing this for 40 years, all over the world, over that time period, most every country has tried to launch a technology bourse, technology market. Most have failed abjectly. What determines the success of new stock markets? The most important thing they show is shareholder protection. Other things matter too, how well developed your financial system is, but the single most important factor is shareholder protection. And those of us who do corporate finance aren't really surprised by that. But kind of intriguing, one of the things we could look at here is, could growth equity actually be an alternative to a stock market? Right? In many ways it is. It's an alternative to IPOs. Can you provide capital to firms to grow to the next stage? So at least conceptually, you should be able to test whether that's the case. Last one here, though, on this one. This is a study that looks at, is there, within a venture capital portfolio, and they have many companies within a portfolio, and they document that they have a lot of exchange between investee companies, which actually kind of surprised me, but they do. They document that you do have exchanges, economic and information exchanges within the portfolio network. We'll see whether that happens here. Okay, I think this is the last slide, or maybe one. No, this is the last slide. Each venture, this is Journal of Finance 2020. Each early venture capital success, which they define as one additional IPO for the first 10 deals. If you have one more IPO than the norm, and so you're successful, you'll be successful later. You know, is this luck? Is this skill? Or do you just get access to better deals? You get a better deal flow. And they say it's mostly the latter. You have access to better deal flow, but you do have predict later success. This is absolutely critical. The venture capitalists use their bargaining power to extract better terms. This is both a theoretical and an empirical study looking at the terms under which venture capitalists invest. And of course, they have very strong bargaining power with firms, with entrepreneurial firms. And they show that there's a value maximizing, economically optimal contracting form that venture capitalists succeed, right? They get better terms than they use their bargaining power to get better terms. So you can test whether this is the case for us. I guess there's one more slide. The Lerner et al. Show that the best connected leverage limited partners get access to the good alternative vehicles. This is co-investments, other deals. We can test whether that's the case in growth equity. This is the last slide. Many of us have seen this study, either working paper or over the years. I think I read it first time in 2015. Mutual funds. Mutual funds invest in private firms. One of the things, if you see the popular press on the popular discussion on the death of IPOs and the rise of this private equity, is so much of the value being created by the entrepreneurial sector in the US and elsewhere is captured privately. Public investors can't get it. Retail investors cannot get in on it. When Google, Microsoft, Apple, all these companies went public, they were a few $100 million. Now Uber get to 40 billion before they have an IPO. So most of the growth in value is for private companies. So what you've seen as a response is mutual funds have begun investing in private equity, late stage venture capital, private equity. And what they find is that they have different terms on the rounds that have mutual funds involved, in that they get stronger investor protection. And for a mutual fund, one of the things that a mutual fund is going to want to do is make sure this company goes public quickly, right? We don't think that's going to be the case when we look at growth equity, that they're perfectly willing to hang around for years. But this is empirically, they do show that when mutual funds are involved, they have stronger investor protection, and they're very focused on making sure they go public fairly quickly. And the last one is Agarwal and Lubo-Latov look at dual-class firms. I have a fondness for this. My dissertation looked at dual-class firms in Britain many, many years ago. But what they find is that, we kind of know this. There's been a huge growth in the number and importance of voting and non-voting shares, or differential voting rights shares. Google, Google, Facebook have dual class. Many other tech firms have dual or even triple class firms. And they show that it's very common in venture capital, and that it's most common when you have a strong founder, that they want the dual class firms. Okay, so in sum, the many research possibilities open up if in fact this growth equity is found to be a separate category of corporate finance. You hate to say that, we're scientists. We want to see if this is the case. It'd be really cool if it is, right? It would open up a lot of consulting and research opportunities if it is a new form of finance. So, yeah. Thank you very much.